Hi, Michael Glennon from Glennon Capital. This week we're going to talk about corporate travel. So as many of you will know, it's been all over the headlines. There was a report, quite detailed report in PowerPoint format, released by VGI Partners. VGI Partners are an Australian hedge fund. They've got a very good track record in both being long and short selling. They're an absolute return fund. They have an LIC that's listed on the ASX. It's had quite a good, albeit short, but quite a good performance history. And there's some quite smart people that work there. It's controversial because this is one of the first short selling reports that we've seen. So VGI's gone out, they've publicly declared that they have a short position in corporate travel, and that they've released the report with the aim of showing what they think are deficiencies in the reporting business model and some of the other characteristics of the corporate travel model. Now, many of you will know that we held for a very long period of time corporate travel. We bought it just after the float. I think we sold it around 2016. It was $1 float. I think we sold it at around mid-$16 or $17. So exceptional return for us over a 3 or 4 year period. The reason we sold out of the business is it started to trade on a PE well north of 20. It was around 25 times. And we just sort of thought that's a very expensive business that doesn't have a lot of margin of safety if something goes wrong. Subsequently, because it is on that PE, as a result of the VGI report coming out, the stock was down significantly. It was down 20%. That's worked well for VGI. They were able to close out that short position probably and make 20% return in a very short period on their report. But they had done extensive research. They've been to all around the globe, seeing the offices that existed and didn't exist and satellite offices of VGI. They've been through the accounts in quite detail. And management has addressed some of those issues and also acknowledged that there were some shortcomings in their reporting to the market and things that they did and didn't disclose and things that weren't completely factual. Where it leaves us, I think this is a new phenomenon that we'll see more and more in the market. We'll see people that can short sell stocks doing detailed research, releasing it to the market. It means there'll be more volatility. That volatility can be quite good. We maintain quite an extensive watch list of companies that we like, things like corporate travel, but they're just not at the right price for us to be able to go in and buy the business because we think that they're trading on very expensive multiples. So we've had a look at corporate travel post the sell-off. It did rally a little bit the day after that sell-off, but it still didn't represent enough value for us to enter back into the business. But we think management's done a very good job in terms of building the business, less so a good job in terms of disclosures and what they report to the market and the accuracy of some of the things that are out there in the public domain about the business. So at this stage, we don't own corporate travel. We're keeping an eye on it. If it gets beaten up again or VGI comes back and it highlights further weaknesses in the reporting and the business model and management of corporate travel, we may go back and buy the business, but at this stage we're just observing it, and we think it's a very interesting thing to observe because we think there will be more and more short selling reports coming out, creating volatility in highly priced businesses. So it's one to watch. If it gets cheaper, worthwhile having a look at this point. Not enough value in it for us, and it's a very interesting dynamic to look at in terms of where companies are trading on big PE multiples. And we saw this with Blue Sky and Glaucus research report, how much downside you can have as a shareholder in those businesses that are subject to short selling reports.